You're listening to Leadership Powered by Common Sense with your host, Doug Thorpe. Here's Doug.
Today, we're going to hit a big topic that impacts all small business. It's about cash flow. If you don't understand or don't know how cash flow works and haven't yet quite figured it out, you need to pay attention to what we've got to cover today. Hi, this is Doug, and you're listening to another episode of Leadership Powered by Common Sense. This is episode number 2 in my personal journey to come to you just one-on-one and present some ideas to help you with your leadership and what you're doing. But again, like I said earlier, we're going to focus on this thing called cash flow. It is surprising to me. A lot of the small business owners in particular never quite figure it out. They feel the pain. They know they struggle with it, but they don't really get how to more effectively manage their cash and the flow that goes with it, and not to be, no pun intended. But the concept comes from the idea you've got money flowing into the business in terms of your services, your goods, the things you're getting paid to do. That's money coming in, but you also have money going out because you've got to make payroll, pay your rent, pay your trucks, all your equipment, supplies, etc. Now, the magic in properly managing cash flow is to figure out the timing of all that, because for many businesses on the revenue side of the coin, you are sending a bill out to a customer. They may or may not pay you on the spot. And if there is an average lag time for when they are going to make that payment, you don't really get to count that in your available cash number. You've got to delay you've got to delay the timing and knowing that you're going to have that cash at some point in the future. And everybody who's ever been an entrepreneur knows about the pain a late pay can create, because sometimes your tickets are large and you spend a lot of money with supplies and personnel getting a job done, and your customer arbitrarily waits an extra 15 days to pay you. Well, that just delays the whole process and creates a cash crunch. But on the flip side of the coin, the other part of the flow is that money going out. You're going to have to make payroll on payday every time, and you're going to have to pay your rent on time with the landlord. And as soon as you start missing the timing on those things because you do not have cash available, you have a different kind of a problem. So this thing we call cash flow is simply that. It's targeting and tracking the timing of these events. And one of the best tools that I have ever used to help owners understand this is a 13-week cash flow model. It's a spreadsheet. You set up columns for each week, and you have line items down the side. On the top portion of the worksheet, you've got your income opportunities. If it's large contracts where you're getting partial pay spread out over time, you plot those into the weeks that have the dates that these payments are going to happen. If you have some fairly consistent revenue churn, for instance, if you're a restaurant or a more retail-oriented business, do you have an average day's sale that you can expect and count on? You can plot that in week by week. And you take all those revenue line items, you add them together, and then week by week, you look at what your total cash position might be. And on the bottom half of the spreadsheet, you start targeting and itemizing your expenses. You know what your payday schedule is for your employees. So you slot that. Maybe you pay on the 1st and 15th, or maybe you pay every Friday. Maybe you pay on some other schedule, bi-monthly or bi-weekly, whatever. You plot that into the column of the period that money's going to be going out. Same thing with big ticket items like your rent, your supplies, maybe debt service with your bank. If you have some loans and you've got some regular recurring payments on those loans you need to account for, or you're wanting to make regular recurring payments on lines of credit for vendors, suppliers, etc., you can plot those into those columns as well. And then basically what you're doing is taking a look at the net number. And you compare the top side total, which is your incoming, your cash flow incoming, versus the bottom half, which is the outflowing. And hopefully you've got a positive number left at the bottom. That number can be carried forward into the next column as a starting amount to add to the income that might be targeted for that period. And then you start to see a picture of what you're doing. Now, a simple spread like that can create a lot of opportunity just in terms of the regular ongoing business that you have. But here's another benefit of creating a spread like this. You can also think about the need to make incremental spends to grow your business. Maybe you need to go buy a new piece of equipment. Well, the question becomes, am I going to accumulate enough cash that I can pay cash for that item, or am I going to need to finance it? And is that the smart thing to do? Is it's going to be smart to burn a bunch of cash in lieu of getting it financed? And depending on where your business is, you may or may not have the availability of financing to do those incremental things. So you need to begin the process of planning ahead, looking at your flows the way they're happening naturally, and see if you're going to be able to accumulate enough cash to get to that day when you need to make that bigger investment in the business. Now, here's another place where this cash flow modeling is very critical. It is very tempting for small business owners to see cash accumulating in the company and go, oh, goody, goody, I think I want to buy a new car for my personal life. I see cash sitting there. I'm going to take a distribution and go get that car. Well, on one hand, there's nothing wrong with that. That's the reason you should have started. One of the reasons you should have started the business in the first place is to be able to fund a lifestyle that you want to live. But the question is that really what you need to be doing? Is the business healthy enough to be able to allow that distribution, or is the business going to need that cash 1 week, 2 weeks, a month, 2 months, 3 months later? Are you going to need that cash because you've got an old truck on the job that's getting ready to break down, and are you just taking a chance on having that truck being serviceable for you, for the near term? It's those kind of decisions you need to plot out on this cash flow model, and having a 13-week window to look at will give you a really good picture of what you can and should be doing with your cash position. This might be a good place to interject a little joke. As an old banker, we had a joke, and this may not even make sense to a few people now, but the joke is the banker called a customer and said, "I'm sorry, Mr. Jones, your account's overdrawn. You've run out of cash." And Mr. Jones says, "That can't be. I still have checks." Ha, ha, ha. The point being, cash flow is a little more sophisticated than just simply looking at your bank statement saying, yeah, today I've got money in the bank. Good. Maybe you do, but the question is it going to be enough for a week from now, 2 weeks from now, when payroll comes around, rent comes around? All those outflows need to happen in an orderly, timely manner. Now, there's another part of this that I want to elaborate on. I use the example of the owner that wants to take a distribution to maybe go buy a car, and that's just fine. But there's another thing that I think independent owners can get stuck with, and that is allowing certain personal things to intertwine and weave into the business and get a little cloudy. The number one caution I will tell you as a business owner, likely you were advised to go set up a separate LLC to start your business. And the argument was having an independent LLC that creates a new legal entity that creates some protection against you personally being liable for problems that spin out of the business. And there is a matter of law called piercing the veil. If you've set up that LLC, but you bleed a lot of your personal financial matters into the company, constantly moving cash back and forth between the business and your personal account, you create a hole in that veil of protection that the LLC would otherwise provide you. And if somebody wants to come after you in a business way, as soon as they discover that there's been this flow going on, you have lost your protection as an LLC. And they can, in fact, attempt to come after you personally to create liability. Now, that's obviously, if you're an owner, that's something you want to avoid and stay away from at all costs. But that is probably the number one area of risk that independent business owners create for themselves if they're not careful. Now, everything I just said, I want you to validate that with your accounting professional and your legal professional. But I think they're going to tell you essentially the same thing. So you want to be very careful about that. Similarly, what I have seen happen with some entrepreneurs, they will make an accommodation for a friend, a family member. I had one entrepreneur who technically hired his girlfriend to work in the office and do some things. Well, in many situations, that could be legitimate. There could be a good purpose for that. But there was access to a company credit card, and pretty soon expenses started getting racked up on the company card that were very personal in nature, and the card kind of ballooned, created an obligation that the owner wasn't quite prepared to pay, and it got ugly and so on and so on. You probably know the end of that story. But the point being, again, back to the concept of the cash flow, knowing where these expense items are coming from, knowing how they're being handled and reported in your accounting for your business so that you can accurately track and monitor this concept of the flow, the pluses and minuses, you're going to be able to do a much better job of protecting yourself, eliminating some pressure and burden of sweating a payroll because you overspent in another category the week before. That's the whole point of having a good cash flow model that you can work with. Now, for some people who have never kind of gotten into that level of detail with their accounting, I strongly encourage you to find an advisor or a CPA that can help you with the modeling of that. Let them do it for you a few times to get you comfortable with it. But I would argue that cash flow forecast is one of the most powerful tools that a small business owner can keep in their pocket because, again, it protects you from surprises and keeps you from having to stay up late at night worrying about how you're going to make a payroll or how you're going to pay rent. Those are very uncomfortable places to be if you're that business owner. So there's a lot more we can talk about in this area. I'd be happy to talk with you individually, privately, if you'd like. As always, I offer a free discovery call. If you want to hop over on my website at dougthorpe.com, check out, click the link for the discovery call or consult, and we can talk about your situation and see if there's anything else I can do for you and help you streamline and solidify your success as a business owner. For now, I'm going to sign off, say goodbye. Go out there and make it a great day.
You've been listening to Leadership Powered by Common Sense, hosted by Doug Thorpe. If you would like to know more about the coaching and advisory services he provides, visit dougthorpe.com.